Okay, everybody, we're here for take two. We're on a new platform here, and I'm just getting to use it. Zach and I just spent the last 3 minutes getting to know each other better without hitting the record button. So, Zach, welcome to my show, Zach.
Charles, thanks for having me on. I've enjoyed our conversation up to this point, and you're not the first person, right? Like, at least we didn't get through the entire episode. We've certainly been in that situation before. So,
I did that one time on my podcast. My guest was Bill Ham, and do you know Bill?
I don't personally, but I'm familiar with him. Yes.
Yeah, he was a student of my wife's way back when it was first getting started, and he's all about lease options or master lease options for multifamily property. And I'm not kidding you, we had the best show going. We were laughing and joking. And then I look up in the left-hand corner on my Zoom screen. I'm like, is it supposed to say record? And he says, yeah, I know. I noticed that as soon as I came on. I said, Bill, why didn't you say anything? So we had to do it all over again. It was terrible. So it's good to see you, Zach. Good to meet you. As we were talking about before, Zach is are you a former optometrist? I mean, once a Marine, always Marine type of thing, or is when you have the designation, do you still do any practicing at all? Or
well, we do. I mean, I still have my license. My wife is also an optometrist who met in school, and so
okay.
we have the privilege now of practicing on a volunteer basis. We do a lot of humanitarian missions, both stateside and internationally, and because we love a passion of ours helping people see. But of course, we're full-time real estate investors, and so we don't need to rely on that as an income source.
Yeah, awesome. So I had asked you when we first get started. I was telling you the story about Dr. Lee, and Dr. Lee is one of the nicest guys, and he's been our family optometrist for years. And last time I saw him, he said that because of the advances in technology, that his role as an optometrist is going to become more obsolete. And I just thought, that blew me away. I could not imagine that. Is that kind of true?
Well, I think we're seeing this evolution in technology right now, especially in the healthcare setting, where which is a good thing. I think overall, a lot of people are concerned about change, but it's usually for the good. But what we're seeing is, technology can do a lot of the testing and measuring and prescribing, but it still needs to be reviewed by someone and have that signature. We have seen just over the past few years where, some of my colleagues are practicing now in a just online type of setting where they can be on a computer. They have your consultation over Zoom, and you can just have testing done by a local technician and they review it. This happened with radiology a long time ago. Most radiology exams are done and reviews are done by international radiologists and just outsourced. So I think there is this evolution happening in the healthcare industry where technology is certainly changing the game. I don't think optometrists need to be worried about being out of a job, but that's gonna change the dynamic of practice, right? Maybe private practice business, which we were in at one point, in addition to military and other settings and HMOs, we're not, but that could be definitely having some people being conscious about what the future looks like.
Yeah, but now you're a full-time real estate investor, and the name of your organization is Rent to Retirement. So tell me about Rent to Retirement. How does it work? And I think I've interviewed someone that I think is on pretty much the same thing that you're doing many years ago, and I want to see exactly how you're operating and see if it's the same or different than what she was doing.
Yeah, happy to, Charles. We work in what we call the turnkey space, and that's one of these buzzwords that we always hear about it. A lot of people hear turnkey and wonder what that is, and people define it differently. And we also operate in the build to rent space. Those are two kind of areas that we participate in. Turnkey generally means that you're buying a property where someone else is, you're going to be a hands-off investor, right? And turnkey company has either built or renovated the house, leased, and they manage it for you in a market that we've identified, because we work nationwide. So we've identified a market that has strong fundamentals, from legislation, taxes, cash flow perspective, economically and population growth areas. We do due diligence on the best locations to invest throughout the U.S., and then we handle everything for the investor so they can easily get started or scale their portfolio without having to actively manage it. That's essentially what Turnkey does. We work in single family and multifamily, but the majority of what we do is brand new construction. build to rent, where it still can be turnkey. We can handle everything for you, or there's a few other creative ways that you can participate in build to rent. So that's generally our business, I guess, offering. Our mission statement is to make the best investment opportunities across the country accessible to everyone in the residential sector.
Okay, so I've been in this for many, many years, and I spoke to this young lady many, many years ago, and hers was turnkey also. And the difference that I'm seeing between what she does and what you just mentioned has to do with this new concept about build to rent. So hers were renovations. They were, she bought existing homes and renovated them and then made them turnkey for her investors. But, this new concept, especially with Neil Bawa and what have you, he's all into build to rent. How does that differ? And do you do both, or do you just focus strictly on one side, and why?
Well, build to rent is about 70% of what we do. That's the majority of what we do. And probably this next year will be about 90% of what we do. So while we still renovate, Charles, the single family and small multifamily properties in the Midwest, those average house price points could be $150,000 to $200,000. And then, we'll lease and manage them for the investor so they can just buy them. And, those are good bread and butter homes, your B-class houses in the Midwest. They tend to have, even a fully renovated house, if it's an older house, they tend to have more maintenance. Your capital expenditure items will be, even for the first few years, if you have nothing, you need to budget for those. I've been investing professionally for about 15 years now, and I've just learned over time to really like build to rent, because generally speaking, when you're doing build to rent, and this is either if you're doing ground up construction yourself, if you can do infill lots or work with a builder where you can just buy a new house, like with working with us, we'll build the house and you just buy it as a new construction where it's already leased and managed, and it can operate as a short-term rental, a mid-term rental, a long-term rental. We have opportunities in all those sectors. But build to rent is really, I think, an area where you can get more predictable returns. You can get better returns as well, because new construction, builders are building in areas that have demand. So we're usually building in the Southeast, areas like Texas, Florida, Alabama, Carolinas. These are areas where the population is growing dramatically. There's a housing crisis and shortage there. These are areas we want to be in the path of progress. That's where you get the best appreciation for rents and home values, of course, over time. But build to rent is just a really predictable way to have a brand new build house. So you have very low maintenance. You should have no maintenance your first year because of builder warranty. You have builder warranties on the foundation and mechanicals and things like that, 5 to 10 years. It's just a real predictable way to set yourself up for success, and generally hands off. And long term, we see that returns are better. The downside is if you're comparing the two, because we kind of do, we segment out turnkey rehabs is what we call them, or build to rent. So turnkey rehabs is your $150,000 B-class 3-bed, 2-bath in the Midwest, solid cash flowing asset, probably $200 to $300 at the end of the day, be a good double-digit return, cash on cash. But your build to rent, those homes are more expensive, right? They're new construction. It's in the higher priced area, relatively speaking, still rather affordable compared to a lot of markets. So this is a $300,000 house, maybe renting out for $2,600 a month, still positive cash flow. But you're going to see double-digit returns in appreciation in rent values over time. Maybe the rents don't look so great year one, but over time, rents grow. So anyways, I'll stop there. I could go on forever, but.
Okay, because I'm thinking about when you're looking at build to rent, I want to know, first off, how does your company acquire these? Do you bring in the investor and then go source the house for him? Or do you buy it and then you bring in the investor afterwards?
And we do have different product offerings, right? We do have a fund if someone wanted to invest in a fund for new construction, but the vast majority of what we do is where we are developing and building on the land, right? So we're acquiring the land, developing the land, bringing in builders to do the ground up construction, and then either managing or partnering with a local property manager to lease and manage that property and still selling it as a package deal to an end investor. There's a lot of institutional buyers, that operate in the single family build to rent space as well. Those are some of our bigger competitors. Sometimes it's challenging when you have a hedge fund coming in and buying a bunch of build to rent properties or an entire community. So our goal in the build to rent space is to make build to rent accessible to the average investor, whereas historically it really hasn't been. It's been a lot of institutional buyers. Okay,
so what do you do one-offs? Do you do streets, neighborhoods? How do you when you go in there to do the construction yourself? What sizes are we talking about?
Most of these are infill, and so we do have some small community developments, but we really do not build large communities with HOAs and all the amenities and things like that. This is usually just individual standalone homes in an area that's 75% developed already with houses, and there's maybe just standalone lots in those areas. Southwest Florida is a perfect example, an area that we built over 1,000 houses over the past 2 years in is in Cape Coral. And that's an area that's just dramatically growing. And they're just individually parceled standalone lots. But these are houses. These are 4-bedroom, 3-bath. They're high end. These are A-class neighborhoods. That's the other thing is you obtain better quality tenants that are going to take care of the property, stay longer. You have high demand because it's a brand new built house in this area that's attracting quality tenants. And we also build small multifamily, so 2 to 4 units. But the average investor is buying one-off property or whatever it makes sense for them. Maybe they're buying 2 or 3 of these kind of in a general location, or they're diversifying because we have different areas. But we do have, if we have time to get into it, Charles, we do have some really creative financing options where we offer a seller financed interest-only loan for someone at 2.99% if they qualify. We have credit unions that will allow up to 5 investment property purchases on new construction at 5% down. So it's 95% leverage. Now, those may not be positive cash flow at 95% leverage.
Yeah. And
you don't have to only put the 5% down. But hey, if you're an investor that's doing accelerated depreciation and you just want to grow your portfolio and acquire assets and then, possibly refi or let rents grow over time to be positive cash flow, that might be a good option for you. That's exactly what I did.
Wow. 2.9? Is it? Who's giving you that?
2.99% interest-only loan. It's either 2 or 4 year loan. And here's the reason why behind that. And this is with some of our building partners, and this is on Alabama and Southwest Florida inventory specifically. We did sell to institutional buyers with one specific builder partner of ours over the past 3 to 4 years. That buyer has basically stopped acquiring assets because of where interest rates are.
Right.
And so there's a lot of properties sitting on the books that are already completed, already done and rented, that are cash flowing great. They're great assets to hold. But from a balance sheet standpoint, we need to free up some capital to go out and buy more assets, to get more construction loans. So we are offering creative financing options for people where they can come in at a 2.99% interest rate, cash flow like crazy. It's like a 30% cash on cash ROI on that interest only loan at either 2 to 4 years. And then you can refi, or sell the property within that time frame. It's up to you. Hopefully, I'm interested to hear what you think. But over the next 2 to 3 years, I fully anticipate interest rates will. The Fed's already come out and said that interest rates should be going down, right? So.
Yeah. Well, you see, that's the difference between your business and my business. Mine's strictly on the multifamily side, and I think you're going to see a major correction over the next 18 months with a lot of these CMBS notes coming due. On the, when you're trying to figure out what's going on in this, the real estate market, what's happening. Listen, there's a huge difference between what's happening on the single family side and what's going on the multifamily side.
We think the residential side is the safest bet. I think, especially when you get long-term debt. But I personally own a lot of commercial retail, multifamily and industrial. And I have a lot of loans here right now, Charles, that are on 5-year notes that are at 3%, right? And so, now granted, they paid the equity down, or I built significant equity, but we're seeing a lot of builders, as a lot of also on the commercial side that, once their loan is due, they're going to be in trouble. So there's still opportunity coming, I think, in the commercial space.
Exactly. Absolutely. But the thing is, this whole housing market, people are like, oh, it's going to be another crash. Listen, this 2009 and today, it's entirely different, especially when you look to see how much equity most people have in their homes nowadays. That was not the case back in 2009. And, there are so many other reasons why the housing market is entirely different now than it was back then. You're not going to see this crash that we had happen. But yeah, I'm not so much on the multifamily side. Multifamily side, there's going to be a huge opportunity coming up. It's exciting. It's very exciting. But all right, now what areas you keep mentioning Southwest Florida and Alabama? How did you choose those areas? What is it that you were looking for?
We follow the trends, right? It's not rocket science, but it does take some time, and you have to understand what your buy box is, what your criteria is. We work in 2 main geographic areas. That's the Midwest This is your typical, this is not where we do build to rent. This is your typical 1950s house, 3-bed, 4-bed, 2 or 3 bath, you know, your bread and butter workforce housing that has a low barrier of entry. You know, if you want to buy a house with $30,000 down, you can do that in this area and still get a good return. And that's a solid bet. You know, is typically the Midwest is not a really cyclical market. You'll have consistent cash flow and, you know, predictable appreciation, not subject to market volatility. Main markets we work in there is Ohio, in particular, south of Cleveland. So what we would call secondary markets like Barberton, Akron, Canton area. So things like that where there's emerging markets in the Midwest. We also work in Indy, Kansas City, Missouri. You know, Memphis, Tennessee. I mean, everyone's kind of heard of those when that's what they think about the traditional turnkey. The build to rent space is much more in the growth markets like Texas, Florida. We work actually throughout the entire state. I keep referencing Southwest Florida, but we work in areas right outside of Orlando. And one of our best markets is Poinciana, Polk County. This is an area where you're 20 minutes to downtown Orlando, but house prices are a third. The cost of rents are almost the same. It's interesting though. That's an area where you have a lower barrier of entry. You have more potential for growth and you can still cash flow the hell out of those. We work in the Panhandle around Pensacola area, Alabama, all throughout the state. Actually, well, between Huntsville and Birmingham. And then we also work in the Gulf Shores area. So we have some coastal stuff as well. But generally speaking, we want to be in areas, our fundamental criteria, Charles, areas that have landlord-friendly legislation, because I hate having the tenant be in control of my property and being able to sit and squat in it for a year with nothing I can do.
Wait a minute, hold on. Where are you located right now?
I'm in Denver, Colorado.
Oh, okay. Which... So, okay,
we're a purple state.
It's a purple state, you think? Not after what your Supreme Court just did.
Yeah, well, this is the way I look at Colorado. It's a beautiful place to live.
Yeah,
and we love the Front Range. I'm originally from Wyoming, right? And that's about as conservative as you get.
Well, you didn't end up back in Colorado because of your Air Force connections, did you?
No, it's just family. We just like the front. We just like the Front Range. We love to ski. Now, the only properties we own out here. We do own some commercial retail centers. We have 11 small retail centers in northern Colorado between Fort Collins and Colorado Springs. And we own some high-end luxury short-term rentals. And these are in the mountains in Summit County, like some of these renowned, like Keystone and Breckenridge.
Right.
These are some of the ski resorts. We have actually the 3 highest grossing properties in Summit County. And we can talk about that if you want. I don't think that's mainly your demographic, but to get back to your question,
just talk real estate. We could talk about anything, Zach. It's not like my demographic. Just they just want to see me make fun of you and your expense. But I like you too much, Zach.
Well, yeah, and I won't give you too much crap about starting the podcast without hitting the record button, Charles.
Well, no, don't. But listen, I'll give you crap because I went through your website and I noticed some of the old members of your podcast. People have been, and one name keeps creeping up. Chris Prefontaine. How do you know Chris?
Chris, we've collaborated with a lot. He's in the creative finance space. Yeah. We've done a lot with Chris. We've had a lot of our community members that have joined his program to learn how to structure creative deals. And we still work with them. So, I mean, Chris is one of those guys out there that just doing some really interesting creative stuff, right? Yeah. So he does even his own office building, I think he bought on terms. But yeah, I met him when he was in his old office building because he lives in Newport. I'm up here in New Hampshire. I was in Duxbury, Mass at the time, and he and I have been. I've been down to his place a couple times. He had me speak at his events. I don't know if that's where you ever saw me. He brings me up as the comic relief. I don't know why, but that's I love going down there to talk with him. The first time I was down there, I had the day before I went to speak at his place. I had received my pilot's license, and so that was. He said, "Did you fly down here?" And I could have, but I didn't. I didn't want to risk it. That's awesome. Yeah, that's on the bucket list for us for sure. Yeah, so that was on my bucket list. I did it, crossed it off. All right, So we talk about these markets that you're at, and especially the legislative issues that many states have. What states would you? Obviously, the Northeast, you'd stay out of. Ohio, you keep mentioning Ohio, and that's definitely a slow and steady state. I mean, it's a always just slow, increasing very, very, exactly what you get when you move in there.
What other types of areas would you stay away from a legislative standpoint?
I mean, Oregon was the first state to have statewide rent control. Obviously, it depends what asset class you're in, right? So we work mainly in the single family and small multifamily residential sector, at least as our active business. I mean, and we have some short-term stuff, and that's a whole different ballgame for regulation, right? And that's always evolving. But just on the residential side, we just like areas that are very business friendly, tax favorable. Most of the states we work in have no state income tax. That's really important. And
I wonder if you have the same opinion of this state that I do. How do you feel about Texas?
Texas is a great state for business. Texas also has some legislation changing where if you're out of state and you're investing in Texas, there may be some upcoming tax implications with that. Property taxes are absolutely terrible. They're over 2%. For residential, but Texas is an area where if you're investing and you want to, your goal is to be in an area where you have strong growth over time. I think the right areas in Texas is huge, right? So there's obviously it depends on where we're talking about, and it's a diverse state. Texas is over the past like 6 or 7 years has always been, you look at it and it always beats out Florida and other states for population growth. Well, Florida beat out Texas just this past year at 2% population growth. I like Texas, but it needs to be done the right way, in my opinion.
Yeah, two things that I had issues with. Everyone said it was a great place to do business, and it was from a macro standpoint. But man, it was so tough getting good help.
So you mean on the operational side?
Operational side, yeah, that was my problem. And then the other thing that I could not stand, and everybody thought it was the greatest thing. It's a non-disclosure state, and let me tell you, that is not a good thing. Let's keep all the cards on the table. What are you going to charge me next year? And I had one property that went up 3 times on the tax rate in 1 year, and then I had to wait 2 years to fight it. This is crazy. Terrible way.
Texas loves their property taxes because they get breaks in all other areas, right? So on taxes, they have to collect it somewhere. I mean, and we could probably debate this for a long time, but there are benefits to having non-disclosure as well from a privacy standpoint. But there is challenges for sure. Yeah,
absolutely. So, all right, tell me a little bit more. And my final question is going to be, I'm very interested in this, some of your creative financing solutions, and how can someone, sign up with you, get work with you, invest with you, and get access to these creative financing options?
So our goal, we're not a lender. We do have a select few in inventory that can be seller financed at that 2 to 4 year note, interest only. So it's really like an excellent cash flow. That's open to anyone. You still need to go through qualification with that. When the inventory's gone for that, it's gone. It's just inventory specific. We do have a wait list right at this point in time while we're waiting for some properties to finish. But our goal is to, I guess what I was saying, Charles, is that our goal is to assist investors with accomplishing their goals. Whatever those goals are, every person has a different situation, right? They have different they're in different resource and capital positions, different timelines. Whether you're looking to retire from your career path tomorrow, or if this is just a way for you to have a more passive investment and diversify in different locations, get started in investing, whatever the case is, our goal is to put you in touch with the right lending opportunities that makes sense for you. Most of our investors are buying with traditional financing or Fannie Mae, Freddie Mac lenders. Because historically, those have been the best terms if you can qualify for them, but not everyone can qualify for them. So we do have lenders where you can invest with a DSCR loan if that's what you need. We have many international investors that can also, we help you getting access to financing options. If you're investing through a self-directed IRA or 401k, non-recourse debt, our goal is to put you in touch with the right lenders. We have the credit union where you can put as little as 5% down. Now, those are kind of the creative, when we talk about creative financing, that's what we offer. If you want to be a creative investor to go out and raise your own capital or look at, getting some sort of structured deal like sub-2 or seller finance, those aren't necessarily within the realms of what we do. They're not, that doesn't mean you can't acquire properties that way potentially. But our goal is to just help you, put you in touch with the right resources on the lending side. Does that make sense?
Yeah, very much so. So you can take someone looking to do some creative way of getting in the real estate business, and you have it all turnkey right now. They can just bring the funds or have, use grandma's money and they keep their VIG over the return. I mean, I'm looking right now. So those of you that are listening, the name of the website is renttoretirement.com. And what you want to do is when you get there, click on his Turnkey Properties tab. And you can go in there and see that he's got about 35 properties are listed that are available, all different types: new construction, short-term rental, turnkey rehabs, and it lists the price, it lists the projected return on investment, what the cash flow is. I mean, it's just laid out there for you very, very nicely. Zach, you did a nice job with that. But this is very, very interesting. I think I want to find out more about it. You got, and just to finish my thought, Alabama, Florida, South Carolina, Texas. I mean, these are all the states Ohio, Maryland. Check it out, folks. Renttoretirement.com. I think Zach's got a very nice business that he's got operating here. Final question, Zach, and everybody always wants me to ask, how'd you get started? Like, I mean, obviously you were a professional. You and your wife are both optometrists. Yet you had a nice, safe, secure thing. What was the first thing that made you jump into this business?
Well, as many of us can probably attribute our at least initial interest into, I read this little purple book called Rich Dad Poor Dad, right? I mean, that at least changed the thought process. But even before then, the person that had given me that book was my brother-in-law, and his family are refugees from Vietnam. Came over. Just to make the story super short, father-in-law came over from Vietnam, tried to escape multiple times, pulled back in jail, like 10-year process, and then eventually came over to Canada and tried, couldn't speak English, sure, on his back, started in different businesses, failed in all of them, eventually did real estate, got into multifamily real estate. As he grew his single family portfolio into multifamily. And he just always said real estate, he kind of just explained to me real estate's the safest and most predictable way to build wealth. Yeah. And so I just looked at that, and it's not like I was gung ho. I mean, I was on a professional career path, same with my wife. Our first house we bought was a duplex. I used a VA loan because I was an Air Force captain at the time practicing. And so I got
Was she in the service?
She was not. She was she was in private practice. So, but she followed me around, thankfully. So I was able to put no money down, bought a duplex, and I was like, the light bulb went off, right? And so that was about 15 years ago. And then we bought another duplex and just continue to buy from there. I'll say this though, Charles, there was a pivotal moment and that really changed the trajectory of our lives and our investing career path. And this is where we learned how to invest out of state. We learned to invest in different locations where there was better opportunity, not just focusing on our local market because that's what we were comfortable with or knew. While there was still some decent opportunities locally, in starting to invest out of state, and that wasn't easy at first, right? I mean, we made a lot of mistakes and challenges, but learning to invest out of state in different locations where, hey, there's better price points, more appreciation over time. Some of the houses we bought are 3 or 4 times more now. It's just crazy because we were in the right locations. That allowed us to basically excel our investing career, retire from our career paths in optometry, not because we dislike that. As I mentioned, we're still practicing on a volunteer basis, but just because we were financially secure from doing that, and we were able to now make this a full business and help other people follow the same path. So that's my Cliff Notes version of my journey.
Okay. So let me ask you this, because you just reminded me about a lieutenant colonel that I was good friends with many years ago, and he owned single family homes all over the country because wherever he was stationed, he would buy a house and then wouldn't sell it, and then would just rent it out. Is that kind of what you did when you were in the service?
Well, I would say we took a different path. Now, we see a lot of military members doing that because they are kind of forced into this. And we have a lot of military members and veterans, that invest with us because whether, they can easily identify location. They're the least scared people to invest out of state because they know that they're moving, right? They're moving every 3 to 4 years, likely or less. But no, what we did is we bought locally our first house that we lived in. And even that first year when we were investing, we started to invest out of state because after the first 4 or 5 properties, so we invested in different locations based on our investment goals and criteria and where we saw the best opportunity because we learned how to evaluate markets nationwide. And so before we even moved, we had a large portfolio of properties all across the U.S.
Very cool. Very cool. All right, folks, his name is Zach Lemaster. You can call him Dr. Zach like I do, like I've done for years. And the name of his website is renttoretirement.com. Zach, it's been a pleasure talking with you, man. And I want everybody to check it out. It's good stuff. I really like your business model and how you built this as a business and not just a one-off investment opportunity. So good for you. Bravo. Bravo,
Thank you,
Zach. Well played.
Thank you,
All right,
Charles.
man. So good to see it, and we'll talk soon.